A recession is a storm for your money. It shakes plans, but it also reveals what matters most when markets wobble. Today's topic is how to invest during a recession, and this is lesson number 146 in a steady thread of practical money talks. The idea is simple. Stay calm, keep a plan, and use the fear to act with discipline. First, you need a real safety net. Start with an emergency fund that covers 3 to 6 months of essential expenses. Keep it in a place you can access quickly, like a high-yield savings account or a short-term money market fund. Next, clean up your monthly spending. Cut what you don't truly need and automate the rest. The goal is not to starve your life, but to create headroom for tough times and for investing when prices come down. Before you invest, decide how much money you can commit each month. Treat it like a fixed bill you pay yourself. In a recession, small, regular contributions beat big, uncertain bets every time. Put together a simple playbook for the downturn. Split your money into options you can grow with patience: cash for safety, high-quality equities, bonds, and a splash of real assets. The exact mix can shift, but the structure helps you stay grounded. Buy and hold quality. In recessions, strong balance sheets matter more than hype. Look for firms with little debt, steady cash flow, and products people still need even when wallets tighten. Dollar-cost averaging matters more when prices swing. Instead of guessing the bottom, you invest a fixed amount on a regular schedule. If prices fall, your automatic buys get cheaper shares. If they rise, you still accumulate gradually. Don't bet everything on one corner of the market. Use broad index funds to stay diversified. Then tilt a little toward defensives, things people buy in every season, like utilities and everyday consumer staples. Bonds have a different job in a recession. They dampen volatility and pay a steady, if smaller, income. Consider a mix of short to intermediate duration government bonds and high-quality corporate bonds, with a plan to adjust as rates change. Cash can be boring, but it's useful. A pocket of liquidity lets you grab opportunities without selling at a loss later. Keep enough in reserve to cover planned purchases during a market lull. Real assets sometimes help balance risk. Real estate investment trusts can offer income and inflation protection, but they come with debt and rates to watch. If you own physical property, keep a careful eye on rent demand and maintenance costs. Dividend stocks aren't magic, but they can cushion a downturn. Look for sustainable payouts, growing dividends, and reasonable payout ratios. If a company lowers its dividend in a pandemic or recession, you don't want to be stuck in a risky position. Bring in extra money to invest. A side hustle or freelance work adds dollars you can allocate to this plan. The important part is to keep investing after you pay yourself first, not just when you have spare change. Max out tax-advantaged accounts when you can. 401k, IRA, or equivalents should get attention even in a bear market. If you harvest taxes, time it to your situation. The point is to invest more, not chase every market tick. Debt matters. If you carry high-interest debt, plan a payoff or refinancing strategy. Low-interest debt might be safe to keep if your investment returns are uncertain, but avoid using money you need for essentials to bet on riskier bets. Think in terms of risk and time, not luck. The best recession strategy is a long game. Protect what you have, keep investing, and reassess slowly. You're building habits that outlast the next headline. Different becomes you when you're near retirement. Start with a higher anchor on safety, reduce exposure to volatile assets, and plan for reliable income. The goal is to minimize the chance you must sell at a loss to cover living costs. If you're early in your career, use the downturn to learn and keep investing. Time is your ally, and prices are lower because fear is high. Keep a steady plan, don't chase hot tips, and let compounding do the rest. Your mental model matters. Fear makes some people sell everything. Sensible investors keep a structure and act on it. One useful rule is to separate what you can control from what you can't, then act on the controllables. Here is a concrete action plan you can start this week. Write down 3 numbers: your emergency fund target, your monthly investment, and your maximum stock exposure. Then set 3 triggers. If the S&P drops 5% in a week, you buy. If it rebounds 3%, you pause. Automation helps. Set up automatic transfers to your investment accounts and automatic rebalancing if your broker supports it. This keeps emotions out of decisions and ensures you stay on track even during busy or scary days. Avoid common mistakes. Don't cash out in panic. Don't chase every rumor. Don't use margin or complicated products you don't understand. Keep things simple and transparent, especially when headlines scream at you. Here's a rough, practical example. Suppose you have a 60-40 target in calm times, but you're in a recession. You keep 40% in a diversified stock index, 40% in investment-grade bonds, and 20% in cash or short-term funds to act on opportunities. Another practical step is a 4-week ramp. Week 1, audit expenses and identify waste. Week 2, secure your emergency fund plan and automate savings. Week 3, choose funds for the core plan and set up automatic contributions. Week 4, place your first disciplined buys and review the rules. News cycles will try to pull you in every day. Limit your screen time and choose a single daily update you trust. Use that time to adjust plans, not to react to every headline. Know when to adjust. If your earnings drop or your goals shift, revise your plan, but don't abandon it. A recession is a test of patience, not a sign to quit investing. Keep the long view. Markets recover and new industries emerge. Your job is to show up with a steady plan, not to bet on the luck of finding a bottom. Small habits compound. You don't need a big windfall to start growing wealth. Small, regular contributions, kept steady, do more over time than occasional big bets. If you found this useful, like this video, and subscribe for more practical money talks. Share a comment below with one reform you'll try this month and tell me what part of this plan you want explained in more detail. See you next time.